Hi, I'm Ajay Kumar from ajaykumars.com, and today let's talk about the three important things that you need to know before you go for a home loan. So, there are two types of financial institutions that offer home loans, and first one is called banking institutions or banks, and the second one is called NBFCs or non banking financial institutions. So, for example, banking institutions can be your ICICI, SBI, and the like. And for non-banking financial institutions, we have LIC, HFL, India Bulls, and DHFL. All those companies. Mostly they are limited companies, and you can make it out from the name. It will not be private limited most of the times. And that is one thing. So you need to know from where you're taking a loan. Is it from banks or no, NBFCs? Each has their own pros and cons, and we'll go through that in a separate video altogether so that we don't waste time here. So, but just for now, what you can say is like the interest rates are usually higher side when compared to banks with respect to NBFC. So, LIC may have a higher interest rate compared to SBI, and however, the procedure of application for applying a loan will be considerably easier when you talk about LIC compared to banks or non-banking financial companies compared to banking institutions. So having said that, let's move to the next one. Next one is your loan eligibility factor. The next one is your loan eligibility factor. First, you need to know how much of loan you're eligible for. First of all, based on that is when you can plan your EMI or expenses accordingly. The banks usually give a grant loan based on your net take home salary, and they have a calculation for it. They usually take into consideration of 45 to 50% of your salary, and then see if the EMI that is scheduled for that specific home loan can be paid using that salary. So they just give you, if you're talking about 50,000 as a net home take home salary, they will take 50% of it, 45 to 50%, which is 25,000, and they'll see if the EMI is being paid by the 25,000 without touching the other 25,000 that you have as your salary to take care of other expenses. That's how banks work, or NBFCs. Any financial institution works for loans, okay, for the eligibility factor. So, in case you have a loan already, like a personal loan is already there on running in your account. For example, let's take 4 lakhs as one personal loan for which you're paying 14,000. Then your eligibility comes down considerably. So, out of 50,000, your 14,000 goes away, and the remaining is 36,000. So the bank will take only 45 to 50% of your 36,000 as your EMI repaying capacity. So that brings your eligibility considerably down. So for which I advise that it's preferable that you go along with a co-borrower or co-applicant so that the eligibility is increased, and you get a better offer. Usually if the co-borrower happens to be a woman, there are very attractive offers being offered by the banks for in interest rates. So we can try that out. Third important thing is interest rates. So interest rates is doing the rounds all the place, and it can be quite confusing which one to go. It is just matter of 0.5%, you can have 0.1%, that can be a difference. But ultimately what matters is how much of savings does it bring to you over a period of couple of like 10 years or 5 years. Initially you should be more careful in choosing a interest rate that cuts down your total amount payable. For example, change in 0.5% to 0.10% can bring down a loan of a tenure of 25 years loan by 2.5 lakhs. So I'm assuming this is for 50 lakhs property. This is what I'm talking about. So that makes perfect sense for you to reduce the total repayment amount. And so while talking about interest rates, we can't ignore fixed versus floating. So fixed, as the name implies, is fixed throughout a specific term. For example, ICICI has a 10-year tenure fixed loan rate where they charge a premium interest compared to normal floating rates. So what happens here is for 10 years you have a peace of mind that your expenses will not go haywire, or your financial planning will be much better. However, there are companies which charge prepayment. Not sure about ICICI, but there are companies which charge prepayment on foreclosing or pre-closing a fixed tenure home loan. So that is the flip side, and usually the interest rate is considerably higher compared to your normal floating rates. So coming to floating rates, as the name implies, again it's floating purely based on market conditions. So as per the market condition changes, RBI revises the base point lending rate. So based on that, banks take in a decision to change or modify the interest rate. It can go up or down based on RBI's mandate. So having said that, if you can go with the floating interest rates, the advantage is you will get a very cheap interest rate, but I'm not sure how long it will be. There are plans wherein different banks or institutions offer tenured, fixed, tenured, floating. So there are options over here, so where you can make a wise decision and choose. So ultimately, floating may offer cheap rates, but the EMI will change and it can affect your financial planning. So those are some of the 3 important things which I personally feel should be taken into account before you go for a home loan. So if this video you like this video and want to have much more informational content from me, please feel free to drop in the comments, and please like and subscribe if you like my channel.